Good afternoon. This is Arlan Suderman, Chief Commodities Economist at INTL at Stone, and happy to be back with you here again today for another of our webinars talking about the USDA crop report. And first I need to put up the disclaimer slide and let you get a good look at it as we prepare to talk about this morning's report, which was full of a few surprises to the trade. And did result in an interesting trade day overall. We saw, first of all, the computers sell the market, and then the human element came into it. We saw the market come back and actually erase the bulk of the losses going into the close. So we'll try to talk about that as we go forward. Price is still a function of supply and demand, but it's modified by the flow of money. So we need to look at the atmosphere into which we came into this report, because it certainly did play into the response of the market, and I think says a great deal about the environment going forward here now. First of all, as we look at, we see that the dollar has been stumbling of late, trying to rally, but just lost a lot of the momentum that we saw post-election. And a lot of that is as the market waits for actual action on tax and regulatory reform early on after the election. And in fact, I would suggest even after the inauguration, we saw whenever President Trump or one of his people would be on the TV during the trading session and would talk about progress being made on tax or regulatory reform, we'd see the markets of stocks in particular rally, and we tend to see a more favorable environment for the commodities as well. But today, when President Trump was on, he was talking about tax reform is coming soon. He was talking about how the trade could be happy with and be some pleasant surprises with NAFTA coming forth. He talked about eliminating totally Dodd-Frank, and that had virtually little, if any, impact on stocks that were trading at the time. And so I think Wall Street has really grown to the point now where they're saying, okay, we've been giving you the benefit of the doubt for President Trump and Congress combined. We've been giving you the doubt. Now we want to see action. And I think over the next 30 days, we're at greater risk of them simply giving up if they don't see significant progress. So this is a real concern for the commodity sector that I want to highlight. We came into today's USDA crop report, which is at noon Eastern time, 11 Central time, in kind of a negative environment. And it was shortly after the president had been speaking, and the stocks were lower, the dollar was lower, commodities were under pressure, and it was somewhat, not a big sell-off day, but somewhat of a risk-off day. And that kind of helped set the negative tone for this market. The dollar continued to fall as we went forward, and that eventually helped us. But as we look at the CRB index, and keep in mind the CRB index is 39%, the energy sector 23% crude oil, and crude oil has been rallying of late. You see, this is a weekly chart here. So you see kind of the bounce didn't go all the way down to test support to that sideways channel last month, but it is trying to bounce off. We did find some buying just above that support level. And so crude oil's been trying to rally back up again toward the top of its trading range. Got within a couple of dollars of that yesterday, kind of stalled out today a little bit. The CRB largely in a sideways trading range as funds going to say, okay, are we going to come back and buy the commodities or are we not? And that really, I think, to a great extent, that tone gets set on Wall Street's impression of what's happening in Washington. Now, when we look at the continuous commodity index, which is more equally weighted, you see that we don't see that little bounce over on the right-hand side of the chart. That it's continuing to trend down. A little bit of a bounce today, but we didn't really change that downtrend at all. We're still above the bottom of that channel. That's going to be a critical area. We break through that. We increase the selling pressure on the grain and oilseeds. We bounce off of that, and that gives an opportunity, anyway, for the grain and oilseeds to see a follow-through bounce if they get some help from the fundamentals. So here again, here's the environment in which today's report was seen. We see here the correlation between the orange line, the CRB index, which we looked at a couple of slides back, and the shaded area being net fund ownership of corn, soybeans, and wheat with a pretty strong correlation of 0.73. Now, looking at the numbers that mattered from today's report, and overall, first of all, I want to highlight these South American production estimates that we see here. Soybeans in Brazil, 111 million metric tons. Corn, 93.5 million metric tons. Argentine soybeans at 56 million metric tons. Argentine corn at 38.5 million metric tons. When you look at these numbers, they are significant. Oops, didn't mean to advance. Okay, we'll try that again. They are significant increases from these numbers from last month that USDA had. But they were all very close with the exception of Argentine corn, where we were 1 million metric ton lower. The rest of the numbers are pretty close to our numbers, and I thank our partnership with the offices that we have in South America for giving that insight and those estimates. But they were well above what the trade was expecting. And so that was one of the first things that the trade saw coming into this report as the numbers came out. That translated into larger than expected global ending stocks. In fact, if you look at this soybean ending stocks number of 87.41 million metric tons, it was above the highest of the trade guesses, which was our guess at 85.75 million metric tons. So about 1 3/4 million metric tons above our estimate, which was the highest in the industry. When you look at corn, we're still, well, a little over 2 million metric tons. That comes out to about 80 million bushels. We are above where USDA came out on the global stocks, and that's largely because I believe that USDA still needs to cut its feed usage a bit more, and I believe that today's ethanol demand usage was a little bit too high. Now, we'll talk about those numbers here in a little bit more, but I did want to highlight overall that the numbers were bearish, and we'll go into the specifics a little bit more down the road, but the market's reaction by rallying, first sinking and then rallying, that reversal would suggest, especially for wheat, that perhaps the worst of the data is behind us. Now, for a little bit of perspective, go back to January, February of 2016, when the crude oil market was trading down below $30, even down into the $26 range for WTI. And I commented at the time, I am not bullish crude oil, but we are getting down to a level now where the funds are becoming reluctant to add to their short positions. And so we're starting to lose some downside momentum because we're getting down to a level where crude oil has some real value. And even though stocks are getting bigger, the funds are saying we can see the light at the end of the tunnel where they start getting smaller once again. So don't be surprised if we begin to see the funds cover their short positions, take profits on those positions they've been writing for quite some time, and that starts to turn the charts. And as the charts start to turn, then you get some bottom pickers coming in and start to buy the new trend. And lo and behold, that's what happened. And we essentially doubled crude oil prices in the months that followed, even though crude oil fundamentals didn't improve. In fact, they kept getting worse for a period of time and aren't much better now than what they were then. Well, the same thing can, and I emphasize can, happen in the grain and oilseeds market. And if anything, I sense that the first crop to do that would be the wheat market, because it probably has the greatest risks in front of it right now. I am not bullish wheat, I am not bullish corn, I am not bullish soybeans, but I do not discount that possibility, just as I talked about crude oil in the winter of 2016, and think that is something we have to be prepared for. Now, what facilitates something like that happening? It's when the environment becomes more conducive for the funds to invest in the so-called riskier assets. Wall Street starts to feel more comfortable taking those risks. That environment is not there at this time, but today's reversal, and we found support from the outside markets. The grains were rallying off their lows as we saw stocks come off their lows and commodities as a whole, the commodity indices, come off their lows and move into positive territory. So we got that outside market support. If we see follow through of that support, then I think we could see wheat actually try to lead this grain complex higher. They will come up with fundamental reasons to justify it, whatever it may be. You can always find something. They will do it in order to justify it, just to get the market to move, because they don't make money, fund managers don't, in a stagnant market. And we're getting down to a point where they're becoming reluctant to take it lower, just as they were in crude oil in the winter of 2016. Now, as we look at fundamentals of where we're at on corn stocks, this is looking at domestic corn stocks in absolute terms. You can see that old crop stocks are basically at 29-year highs. As I look forward, and I'll show you the data a little bit more specifically here a little bit later, new crop stocks look to be a little bit smaller. Still near those 30-year highs, but by not in continuing to get bigger, starting to turn the corner. And then if you get a weather problem, it would get smaller at a faster pace. But that's kind of what the funds are looking at if they want to justify such a move. As we look at soybeans, the demand continues to grow in China. That's driving the demand market. We do not have USDA's estimates yet for 2017, 2018. We will have those starting next month. But my projections, which you'll see work out in my balance sheet later in this presentation, or the results of it, shows that continued growth in demand. Yes, we're slowing down the growth of the hog industry in China, but we're continuing to grow the poultry and beef industry, although that's somewhat smaller. But it's a poultry industry in particular is a larger consumer of protein and of soy meal protein in particular. And then when you look at the fact that China continues to lag in its inclusion of protein in its ration, and get better at it or increase that protein content more, I see the demand continuing to rise. The numbers that I show you, I will have been very conservative, only looking for a 3.5% increase in demand for China for next year, which is markedly slower than what we've seen, and I still see some pretty good increases in exports. Now, for the current marketing year, we see here again USDA's tendency to push exports higher after the April report. They've done so in all but 5 of the last 22 years. Last year, significantly so, but that was because South America ran out of soybeans because they had a short crop. I don't think that we'll see that big of an adjustment this year. The question is, will they have to raise their export target another 15 to 20 to 30 million bushels, or will they have to start pulling it down? USDA is holding the line right now. Exports are about 75 to 80 million bushels above the seasonal pace needed to hit USDA's target, but that's trending lower. That gap is narrowing on a week-to-week basis. I say week-to-week basis. This week it actually increased. Soybean stocks here again tend to come in below as a result of those exports growing from this point forward. Soybean stocks tend to come in below USDA's April estimate. Last year was considerably so, and again, as I indicated, probably not going to see that scope of adjustment this year. Let's take a look now at weather, and I'm looking here at Midwest weather. Suffice it to say, South America has big crops. The one big question mark yet is the safrinha corn crop in Brazil. If you look at the weather, the growing conditions to date, you will see that Mato Grosso, many surrounding areas where the safrinha corn crop is grown have been receiving below normal rainfall. But normal rainfall is much more than what the crop needs through the month of March and into the first part of April. That starts dropping off into April and considerably into May. We go from about 8 to 10 inches of rainfall per month in March down to about 4 inches in May, dropping off to almost nothing as the corn crop is finishing up in our summer and in their winter. So to date, the corn crop, which is expected to do most of its pollination the last half of April and the first half of May, moisture has been more than adequate to this point. It is expected to remain adequate, assuming that the expected rainfall for next week comes through. That's in the forecast for next week. If that happens, then we continue under nearly ideal growing conditions in Brazil. So the trade is going to say that's behind us. And we may see a little bit more upward tweaking of the production estimate, but basically the worst of that fundamental news is behind us. Now we're going to focus on the U.S. Midwest. So as we look at spring planting, we look at these maps right here, temperature on the left, precip on the right, 16 to 30 day on the top, the month of May on the bottom. And it really doesn't show any significant temperature problems, probably a little bit cooler in the northern plains, northwestern Midwest, what we'd like to see in May following, but that's May, that's not April, and that follows a warmer April up in that area, at least the last part of April and first part of May. If we look at rainfall, there are some risks, particularly in parts of the southwestern Midwest and the Delta and the South, not the Southeast, but I would say more of the Mississippi River Valley, the Delta, the Mid-South, that area, where we could lose some corn acres from being persistently wet, particularly in the southern part of that region where heat comes in earlier than other areas. And they like to get the corn in early, and if they can't, they'd be more tempted to make a switch over depending on what they've put on the ground already, make the switch over probably to soybeans in that type of an environment. That should happen. Much of the rest of the Midwest looks to be okay and not seeing significant problems. We may need to watch a little bit of dryness for the North Dakota area as we go through the spring. But overall, we do not see a major slowdown or delay in planting, but there is the areas I indicated could be the possibility of some lost corn acres. Now, as we move into the summer, first of all, here in the upper left-hand corner, you see the latest model projections for the ENSO cycle. Now, when we get above the 0.5 degrees Celsius warm anomaly above normal sea surface temperatures in the equatorial Pacific, that moves us into a weak El Nino. When we get above 1 degree, that moves us into a moderate El Nino. So a weak El Nino appears likely at this point. We're particularly watching for this period of June, July, August, this window right in here. So right now, we're looking at a likely weak to maybe moderate El Nino. If you come down to this lower graphic, looking at the June, July, August time period, we see here about 67% odds of getting into an El Nino phase, about a 2 in 3 odds, and about a 1 in 3 chance then of ending up in the neutral cycle this summer. So probably going into an El Nino, and now we're even looking at the chance of perhaps a moderate El Nino. In this type of environment, that really doesn't change the outlook the Commodity Weather Group had for the summer, the analog years. But when you get in that kind of environment, the other thing you need to pay attention to, as we see in this graphic in the lower right, is sea surface temperatures, particularly off the West Coast and especially off the Baja of California. Right now, they're very warm, and the models continue to project that they will stay warm. There is some cooler water as we get into this Gulf of Alaska area. Generally, the models are suggesting that that's going to moderate. That's what we're seeing. If they don't moderate, then that can give us some problems, particularly in the western Midwest summer and the northern plains. But right now, that seems to be on track. If you look back at those summers and the work that Commodity Weather Group has done, if you look back at those summers that saw dryness in the southern Midwest, the Southeast, the plains, here are a lot of well-respected people out there, people I have respect for, saying, well, those years tend to move the dryness into the Midwest, and then you have a dry Midwest in the summertime. But Commodity Weather Group looked back, and virtually every one of those years had cool sea surface temperatures off the West Coast. And right now we're warm. And each one of those years that had warm temperatures here ended up having a good summer in the Midwest. So right now we have to assume that we're going to have a favorable Midwest summer based on this. And we'll look at some of the implications here in a bit. But that sea surface temperatures off the West Coast combined with a weak to moderate El Nino kind of sets the stage for that. And one other thing to watch, it may provide a little bit of risk. There's been some talk about 2012 and 1988. And in those years, well, that went too far. Okay, let me try this again. In those years, we had more variation in temperatures here in the Pacific, which allowed more amplifications in the jet stream, as laid out here by this red dashed line. And see how ridging then formed in the eastern U.S., pushing this ridge upward, or this storm track upward over the Midwest, above the Midwest, up in Canada. And so the Midwest turned off pretty hot and dry. This year, with more uniform temperatures across the Midwest being basically above normal temperatures, that allows a more zonal flow. And if there's any area of risk, it would be in this eastern Midwest area, predominantly Ohio, maybe a little bit in Indiana, but the upper Ohio River Valley, particularly in Ohio, that's an area that we may need to watch for some dryness developing as we go through the summer. Now, as you put it all together and look at the analog years, and Commodity Weather Group put this together, and going back to 1950, looking for analog years, similar drivers to some of the things that I've been presenting here. You see it breaks down into hot and dry years in the upper left. 28% of the analog years are hot and dry. That's an elevated risk, but it's still less than 1 in 3. It's a little bit more than 1 in 4, but still well under 50% odds, and even below 1 in 3 odds that we'll have a hot and dry Midwest summer this year. Now, if we happen to get that, you'll notice that the average yield in those years was 10.6% below trend for corn and 4.8% for soybeans. So that would be about a 45 bushel yield for soybeans, a little above that. And for corn, that would be about 152, 153 bushels. That would be bullish. In fact, both of those numbers would probably be bullish to the market. But again, it's 28% odds when you look at all the analog years. On the other hand, the other nearly 3 out of 4 years, better than 70% certainly of the years, saw above trend yields because they were either warm and wet, cool and wet, or dry and cool. And in each of those 3 scenarios, we saw, as circled in the red there, above trend yields. Now, when you look at the possibilities of those above trend yields, for corn, it varied anywhere from a repeat of last year's yield of just above 174 bushels per acre, all the way up to just shy of 182 bushels per acre. Both of those numbers would be rather bearish, even with the reduced acres that we see this year. So that is a risk to the downside should we get that favorable weather pattern developing. On soybeans, that takes you all the way, that doesn't give us a repeat of last year's yield, but it does suggest that we could approach that 50 bushel yield level below last year's 52.1, but still approach the 50 bushel level. And as we'll see here in a little bit, that would still be bearish as well. We really need to see something closer to a hot, dry summer, particularly a finish to the summer, to start becoming more favorable for the soybean balance sheet from a price standpoint. As we look at overall, what is Commodity Weather Group's outlook for the summer? At this point, I would say that you see June on the left, July in the middle, and August on the right. First of all, I want to draw your attention to the bottom, and that's the temperature graph. And it shows the northern tier of states being basically favored by cool or very mild temperatures, with heat being greatest in June, but even at that, it rises up into the central plains and across the southern Midwest is not really oppressive heat, and it's early enough in the growing season that it's, as you see by pollination and pod set, it's really pulled back in July and August, and so really not a factor. So based on this forecast, we really don't see heat being a factor for the corn and soybean crops. When we look at precipitation, we see plenty of precipitation in June across the bulk of the Midwest, continued wet there in that eastern plains into the lower Mississippi River Valley area that the previous maps I suggested we might have some planting problems, so that's an area to watch. We also need to watch for some potential drying start to show up in June in portions of Iowa and Wisconsin. But then most of those areas seem to get rain in July if the forecast bears out. We do see some pockets of dryness here and there. But overall, the cool temperatures, or I should say mild temperatures, help kind of offset that stress. One of the things I want you to be aware of, there's various models out there. One of the main models is the Euro model, the Euro weekly model that is also utilized for the monthly forecast. And you see those rain, well, first of all, temperature outlook across the top there. You see that versus the March run, it's warmer for Canada, but cooler for the Midwest. When you look at rainfall, it's overall pretty wet for the southern Midwest, central plains, and into the southeast. I know the South farmers in southeast would certainly love to see that. That would be timely for pollination in that area. But July, things start to dry out in the northwestern half of the Midwest, not significantly so, but slightly drier than normal conditions. And the dryness kind of intensifies across much of the Midwest, as we get into the month of August over on the right-hand side of the graphic. Now, temperatures also are cooling by then if you do a breakdown of the members of this model. And so therefore, Commodity Weather Group still does not see this as a significant yield threat, but we would probably be most concerned about soybeans at that point in the season. If you put it all together, here's my anticipated most likely scenario on the left, and then I develop a likely bearish scenario in the center and a more likely or a very reasonable bullish scenario on the right. The blue bars represent what I anticipate in the way of ending stocks for the 2017-18 marketing year. And as you can see right now, I'm looking for 2.1 billion bushels of corn left over at the end of the next marketing year, which doesn't even start till September 1 of this year, justifying a marketing year average cash price around $3.45. This is based on USDA's acreage of just shy of the 90 million acres and a trend yield of 170. If we have a repeat of last year's yield and we get 91.6 million acres, which is what our survey showed in mid-March, which was later than USDA's, that would give us almost a 2.5 billion bushel carryout in a marketing year average cash price projected at $3.25. On the other hand, if we get enough wet weather and we don't get the 90 million planted, we only end up with 89 million acres planted, and we pull back the yield a little bit with that kind of dryness in August. 165 bushel yield is not far under trend at all. That's only 5 bushel below trend. That starts to pull down stocks to about 1.5 billion bushels. That justifies a move in the commodity sector and buying of corn at a marketing year average cash price of $4.50. Here again, that is not what I'm projecting. I'm projecting what we see on the left, which would basically say the worst is behind us. The middle scenario would say the worst isn't behind us. So what the funds will assume until proven otherwise is probably something closer to what we see on the left. And so this is what we go into the new marketing year with. USDA will release its first balance sheet for 2017, and we can compare this with in the month of May in the May crop report on May 10th. As we look at as we look at the soybean market, not quite as favorable as it was. I'm using USDA soybean acreage, about 89.5 million acres, and a trend yield of 47.5. That gives us ending stocks of 537 million bushels. Nothing bullish about that. A marketing year average cash price of 910. It would be lower than that if not for the soybeans that have already been priced. If we have a repeat of last year, we don't get the corn acres planted, so we plant a little more soybean, we could push that ending stocks up to 971 million bushels, almost talking wheat fundamentals there. That would justify a marketing year average cash price just above $8, and it would be lower than that. We'd probably see futures broke below $8 if not for the job of farmers doing selling on the way down. On the other hand, if we see a pullback in planted acres like our survey suggested, here again our survey was later than USDA's, this is our survey number, and we get a 5% pullback in yield due to a little bit of dryness in August, then we pull ending stocks down to what, about 4.5% stocks to use ratio, justifying a marketing year average cash price of 11.25. So there is a little potential in there, but the more likely scenario is at this point rising soybean stocks over the coming year. For wheat, let's start off by looking at old crop stocks, broke down by class, and you see here that soft red winter wheat stocks are projected to be just shy of a 9-month supply. Hard red winter wheat supplies are looking at between a 7 and 8 month supply, about 7 1/3 month supply. Total wheat supplies are at about a 6-month supply. That is why the trade has not been overly concerned about dryness in the plains, which of course now we have rain, but earlier in the year we had dryness. We've had some cold outbreaks. But overall the market has not been too concerned. But then again, the market seldom does become too concerned about problems here in the United States. They tend to get more concerned, and we've got the data to back it up that there's a stronger correlation to what's happening in Europe and the Black Sea. So let's take a look at that. Why might that be? First of all, their headlines get more noticeable. But second of all, look at this. First of all, look at this bottom graphic. Who's the big producer in the way of area? It's Europe, the European Union. They're the ones, I'm sorry, I get this wrong. Nope, that should be right. This should be, European Union is right here, the yellow. This is the former Soviet Union. So between these two, we have a lot of area planted to wheat. So if you adjust the yield, just 1 bushel per acre, that makes a big impact on the balance sheet. Then when you look at the European Union at yield, their yields are heads and above the rest of the other major exporters. So a 10% drop in yield for the European Union on the acreage that they plant tends to have a big impact on the balance sheet. Similar, although the former Soviet Union, the Black Sea region in particular, doesn't have near the acres. I'm sorry, I got that flipped again. Has the acres, but doesn't have the yield, but because it has the acres, that has a big impact as well. So therefore, when they do have a drought, it does dramatically impact the fundamentals, and so therefore it bears watching as we go forward. Excuse me. I'm trying to make it through this. Okay. Now, so let's look at weather. First of all, I want to show you this is a condition index for, this is showing the percent, the European Union, the portion of global production that it produces. So what is that, about 21–22% of global production? It has been in declining conditions of late, and as we look at this graphic down here in the lower right-hand corner, we see rainfall as a percent of normal over the last 30 days, and you see that dryness developing over Germany, France, Spain, Italy, and some of those key wheat-producing areas. that's starting to cause that decline in conditions that we saw in that upper left-hand graph. The lower left-hand side, you see April-May weather forecast in the far upper left-hand corner of that graphic. That would be in this area in here. And you see that the general expectation is that most areas are going to see normal rainfall during that period of time, maybe drying out as we get into June, but the crop will certainly be further along by that point. Temperatures are rather non-threatening at this point, except in France and Spain, a little bit above normal. As we get June, July, and August, we're really going to have to watch this above normal trend here that we see in the Black Sea region that could in much of Eastern Europe, Russia, and Ukraine. I think particularly for Russia, that is a threat for the corn crop. But that could be a problem for Ukraine corn and soybeans as well that we'll have to watch going forward. Now, as we look at the balance sheet, I've already shown you the expectations of where I expect things to come for corn and soybeans, and now I want to look at wheat a little bit. Thought I'd give you, as Mike would say, death by spreadsheet, death by PowerPoint due to spreadsheet usage, and a more complete balance sheet for wheat. I want to focus here on these ending stocks numbers. Hit the wrong one again. Okay, right here. Ending stocks of old crop. USDA came in today at 1.159, IC 1.179. So it means my beginning stocks in the new marketing year on June 1st to be a little bit larger. I see overall feed usage declining some more next year. See how USDA came down 190 million bushels on feed usage today, and I'm at 185 and have been. I see that declining a little bit more the next year. Exports declining as well. But still ending stocks dropping down to 989 million bushels. So that's a decline of about 200 million bushels of what, about 17% or so. So there's nothing bullish about this, but it's less bearish, going back to what I was saying earlier about crude oil market in the winter of 2016. Now, if we get a few more acres in there, then we could, in a repeat of last year's yield, we could grow stocks to 1.2 billion, not that much over where we are now. So it's more difficult to develop a bearish scenario for wheat at this point. Here again, I think that's why the funds are going to start saying that the worst is behind us for wheat. On the other hand, if we drop wheat acres by another 1.2 million, and that would take place in the spring wheat belt predominantly, although I still think we could lose a little bit of winter wheat. But if we don't get the spring wheat planted, our survey would suggest that USDA was overly optimistic in the first place, and then if we stay wet in the northern plains, I think earlier I said we've dry, they're anticipating it drying out, but if we stay wet to the point where we don't get the spring wheat planted, when it's got negative returns anyway, they just say, forget it, I'm going to grow some soybeans or canola or sunflower, and we drop down to our estimate of 44.9 million acres, and we get a little bit of a drop in yield because of some dryness or some problems, all of a sudden then we could be looking at, hold your breath, 784 million bushels. That still isn't bullish. That's my most bullish scenario right now, and that's still not bullish, but it is considerably less bearish than what we are now. So that's kind of the summary on the wheat. Overall, what are your take-home points? Wrapping it up, today's report provided nothing of substance for the bulls. Yet, we could see fund managers declare that, quote, the worst is behind us for corn and wheat. And I think that would provide some support for soybeans as well. The ability to do so likely hinges on the macro markets and on sentiment there toward the economy and toward the commodity sector. And I think that'll hinge a lot on how they feel about progress being made in Washington toward tax and regulatory reform. Excuse me. The 2017 U.S. weather threat could still energize the markets on our balance sheets, but that is not currently anticipated. The markets do not remain stagnant. They will move, and they are already near multi-year lows that make traders uncomfortable. So, will we sustain a rally? Follow the money supply. Remember the example of crude oil and what it did when everything looked the bleakest. Are we going to do that? I don't know, but be prepared for that possibility. But for you as producers out there, also make sure you've monitored your downside price risk, because if those bearish scenarios would develop, we could take these markets another leg lower. So with that, I want to open it up for questions. And so, Jake, could you read me the first question as it comes in, please? And we'll take a look at answering these questions as they come in. You can enter your questions on the monitor there. Those of you who are listening today, I want to thank you for participating. Also want to thank you, while I think of it now, for participating in our surveys that we've done. Those of you who are clients, those have been a tremendous help toward us and hopefully to you as well. So I open the mic up now for Jake to read us the first question. Any questions out there? Any questions that you might have? And appreciate that note from Francisco. And okay. All right, here we go. Got a question. Let me try to enlarge this so I can get a better, okay, now I can see it. Do the meats trade in opposite direction grains in general? Cheaper grains equal cheaper to keep meats alive. Today's meat rallied. Why? Anything to do with the grain supply? Excellent question, because we saw the cattle market rally as the crop report came in. Now, we did see some favorable numbers in the livestock portion of that USDA report. But I think the bigger impact was probably the prospect for cheap grain. And when grain is cheap, that meant feeder cattle went down, and the profit margin opportunities for feeder cattle improved, and so therefore we saw buying in the feeder cattle market, and that boosted the fat cattle market as well. And so we tend to see that. On the other hand, we saw an opposite reaction. Not that's as significant today, but overall that's a tendency with pork, where cheaper grain says more rapid expansion, and so they start worrying about increased numbers exceeding supply, and so we tend to see more pressure on the pork when we have cheaper grains. So they move in tandem. If grains go up, then pork prices tend to go up, etc. On the cattle, though, we definitely saw a rally in the feeder cattle market, which helped support the live cattle market with the cheaper grain. Now, George asked, how is export for corn and soybean and wheat for the next 3 months? Overall, the corn exports have been solid. They've been strong. If you've been following it, that's no secret to you. And so, as I indicated, we're well over 100 million bushels above the seasonal pace needed to hit USDA's target. I am looking for, though, about a 25 to 30 million bushel increase over USDA's target in the end, because I think if we continue to see the favorable production estimates of South America, as we get into the summer, a lot of the end users are going to try to delay their deliveries as much as they can and try to get the cheaper corn out of Brazil. That corn is largely expected to be available as we get into late July and into August before the current marketing year is over. And then I think it has its biggest impact in the next marketing year, and that starts September 1. Soybeans are already seeing that decline. We did see a jump in demand this week overall. So we are seeing right now we're about 75 million bushels above the seasonal pace to hit USDA's target. And the overall trend is trending lower. I think in the end, we still probably end up about 15 to 20 million bushels above USDA's target. I do not see us declining from where USDA is currently at. On the wheat, the Census Bureau data, which is official data, suggests that we are lagging USDA inspections for wheat, so we could see that export number decline. Wheat is far more sensitive to the value of the dollar and on competition. And so this is one we have to watch a little more closely because there's a lot of competition out there for wheat. Does the seasonality of soybean, corn, and wheat have any weight on your price assessment? Well, my price assessment, I'm looking at marketing year average. So from that standpoint, seasonality would not matter because I'm looking, here again, compliance doesn't allow us the way we're structured to look at average futures prices. So we look at average cash prices at the farm, which includes basis, et cetera, and we're looking at kind of a range of possibilities. But since it's an annual average, seasonality does not play into that, other than the fact of farmers selling at higher or lower levels of seasonality. Question from Eduardo, does the CWG have a weather prediction for Brazil if there is an El Nino? And basically the prediction that they have to this point is for the remainder of the safrinha corn season, and they are generally expecting wet weather to continue through much of the harvest period for soybeans. So at this point, they think the flooding rains and the persistent rains will probably be limited in scope, but we're still going to have to battle the rains for getting the crop out. The bigger concern is going to be safrinha corn in Brazil, and the expectation that rains are going to continue to trend lower, but remain adequate to support record yields or close to it for Brazil. Is the 87, Kevin writes, is the 87 million metric ton world being carried out a record? And if not, what is the record? It is the highest we've seen in a while. I'd have to go back through my notes, Kevin, and see if we've been that high before. In my mind, we've been up in the 90s, but then again, it's been a long day, so maybe my mind isn't correct. But I think that we've been, in absolute terms, I think we've been a little bit higher than this, but it's going to be up there pretty close to the record. Brock writes, what's your take on moving ethanol blends to 15%? I assume you're asking, what are the odds of it actually happening? I wouldn't hold my breath. The ethanol industry, from the data that I've seen, you get the greatest efficiencies from the automobile standpoint at about 30%. And you see Brazil at 27.5% or 28% or something like that, having virtually no problems with the automobiles. But here in the United States, we have our various lobbying interests that have kept it down to the 10% level, with the newer cars being able to go to 15%. So what's the chances that we could have year-round 15% here? At this point, the people that I talk to in the industry are not real optimistic. Along that line, I might mention that we've been talking about safrinha corn in Brazil, talking to somebody who's down there this week from the United States involved in the ethanol industry, and he's telling me about profit margins are well over $1 per bushel for producing ethanol down there right now, and just getting better because the corn price keeps falling. So it's good. They're trying to build ethanol plants as fast as they can, but as you know, it takes time. But I think the real question, and we talked to our Brazilian team earlier today, is will the Brazil government subsidize freight? Because at this point, average freight from the middle of Mato Grosso to the port is about $225, $228 or so, $90 a ton. for freight, and that'll make it worth more than the price of corn for new crop delivery, according to current price offers that are out there. So some of that corn could just stay in place. There's some sense that we may see the government, they've done it before, to come in and subsidize freight. We'll have to see if they actually do that as we get to the harvest period here later this summer. Does seasonality corn, soybean, wheat have any way? Okay, I think I've answered that question. Let's need to ask it a different way if I haven't. Max writes, I have heard that hog margins are coming down sharply in China. That should reduce their demand for beans. Isn't that very bearish in this ag world? Max, I'm glad you asked that. I'd like to address that question. Hog margins come and go in China, and crush margins come and go in China. And in fact, right now, crush margins for soybeans are very poor. They're not good at all. And so whenever this happens, I hear all this rhetoric about how China's going to shut down soybean imports. It doesn't happen. We periodically see it, but if you look at the data, when the crush margins are poor, they see that as an opportunity to kind of grab bargains in soybean prices, because we're all trading prices lower because we think demand's going to fall, and they kind of build up their reserves and recycle their reserves or rotate their reserves. So we'll see demand drop off maybe a little bit, and not notably, and we don't see it in the annual numbers specifically. So I am not a bear on these margins because they come and go. And I tell you what the bottom line in China is. China is, my observation, China fears social unrest within its borders more than it fears an army crossing its border. And the number one driver of social unrest is food inflation. And the number one cause of food inflation in China is the price of pork. And so therefore, China does everything it can to increase the supply of pork. And even with the expansion in the herds that we've seen here lately, following a period of very profitable margins, they still have some significant limits on where that expansion can take place. Near major cities, it can't happen. Near rivers, tributaries, it can't happen of significance. So their expansion possibilities are limited, and longer term, they're going to have to become more dependent, it looks like, because we're watching per capita consumption of pork continue to climb. They're going to have to become more dependent on imports of pork. So you say, so then why would they need the soybean? Because they're still well below the standard in the portion of soy meal that is in their ration. They can still bolster the efficiency of their production. In other words, if their hog margins are poor, put a little bit more protein in that ration, and you could increase your efficiency and pull those margins up. And that's what Chinese producers are learning. That's why I see the demand remaining strong. Got me on a soapbox, Max, I'm sorry. A great question. I'm glad you asked it. Francisco has another question. Europe this year will be allowed to produce more sugar. Does sugar compete in area terms with the grain crops? Yes, it does. And globally, it's not a big factor. In Europe, it could be a factor. The numbers that I have seen for the growth in sugar, and I know that Europe's going through quite a transition here in producing more beets because of changes in their trade laws that allowed more use of beet sugar. We could see it, but the numbers I've seen on expansion so far, I think the impact on grain area is still rather modest. But keep in mind that's still a factor in a world where we're seeing a reduction, not necessarily big, but less than a 5% here, reduction in U.S. corn acres, then a big expansion overseas. I do not think it dramatically changes the balance sheet. And of course, the wheat crop's already in the ground we're harvesting. Maybe next year's wheat crop, that's something we'll have to watch. John asks, how do Chinese crush margins look at impact on soybeans, palm oil import demand? And I think I answered that, except I didn't specifically address palm oil. I do think it's negative for palm oil at this point. Unless we actually see negative crush margins, decreased crush activity, that decreases the supply of soybean oil and therefore opens the door for palm oil. So it comes down to, does the pace of crush decrease? Remember, this is not a totally open economy, and so you can have things operating at a loss, depends on what state run and what isn't. George says, thanks, and I appreciate it, George. I appreciate the feedback. I certainly hope that this is helpful to you. Reese says, I see the headlines about tax reform, but they continue to cover domestic tax changes. Do you see border taxes coming in play? I think he's talking about the border adjustment tax. The border adjustment tax is something that's been talked about here in the United States a great deal. It's probably a major obstacle to tax reform at this point. Many countries use a border adjustment tax. The United States does not, and that would be taxing things coming into the country, crossing the border into the country. My bias, for what it's worth, is that it won't happen because the Republicans in charge of the Congress know that they had better come up with a plan or they could face some real challenges in the next election after setting expectations high that we would see meaningful tax reform. The problem is, without health care reform, without repealing of Obamacare, you lose $1 trillion worth of savings in Obamacare repeal that can be applied to our meaningful tax reform. So if you don't get the tax reform, then that scales back, makes it tougher to pass a tax plan that pays for itself, which is what you have to do in order to be able to go to the Senate without having to worry about a filibuster. And so that's why they've been talking about a border tax, but I do not think that there's going to be support to get it through. We'll see what it's worth. So any other questions? That's all of them that I have at this point. We're wrapping up at nearly an hour here at 56 minutes. It's been great having you all here. I appreciate it greatly. And not seeing any more questions, I'm going to close it out here and say thank you. And we'll be back with you for that big crop report in May with the new 2017-18 balance sheets from USDA. Thank you.